Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio today. It's going to be a quick video for you guys. We're going to be kind of summarizing a position in Fabio's portfolio, AJRD. He's going to be kind of walking through some of his reasons as to why he made this investment and then some of the recent news that might correlate his initial investment thesis. So without further ado, what are we looking at here today?
All right, so the company is called AJRD, and I kind of want to go over some of the recent price action to kind of first, as always, kind of talk about what's been going on. So we see this initial pop-up, and what happened is Lockheed Martin agreed to buy this company for about $51 a share. And what was agreed upon was a special dividend of about $5 with a buy price of 51. So total acquisition price of $56 per share. I will not, and if you buy now, you will not participate in that $5 dividend. That's already passed. So without further ado, I want to actually say, do not engage or in this trade just because I'm in it. Do not copy my trade. This is kind of just to update everyone and more along the lines of a lesson as to thought process, as to why I decided to engage it and kind of document it, put it out here on our channel. So AJRD for me is more of like a cash position. It's now maybe considered for many people a quite irresponsibly sizable position in my portfolio. And that's again why I say you shouldn't copy, because everyone has different risk tolerances. But that being said, I want to actually discuss the difference between annualized return and absolute return, because I think that's a very core concept as to what drove my initial investment into this company. And you have to understand the difference between the two: annualized return, right, and absolute return. Okay, so first I'll kind of discuss absolute return. So absolute return is fairly straightforward. So there's very few companies that we know kind of like what the end price will be. AJRD, we kind of know the terminal price. The terminal price is $51 a share if the deal goes through. We're going to put a pin on that and talk about that later. So if we know that's going to close at $51 a share, then we can from there distinguish what is the absolute return. Simply put, you take the new price, $51, minus the old price, what you buy it at, divide it by the old price, and then you get your percent not annualized return, you get your absolute return. And it's typically what's going to close out at.
The absolute return in this instance then is your total return that investment has made, just period.
Correct.
So then how is that distinguished from the annualized return in this instance? And then what is the relationship between the two of them? If you wait a longer period of time, then does your absolute return decrease? Because that's where my mind would go with this.
So annualized return brings into the equation another factor, and that's time, right? Because time is very important. Time also has a lot of things that we have to consider, such as opportunity cost. Where could that have capital have been deployed and achieved perhaps better returns? So for example, if I told you there's a 1 month interval for you to generate a 20% return, absolute return. Well, that 1 month, right, is very valuable, right? That's a very valuable return because over the course of 1 month, that return is very high. So in that context, that's good. Now take that same exact absolute return and then stretch it out over the course of 3 years. Now it's terrible.
Makes perfect sense. Yeah.
See?
Okay.
So when you annualize the return, it changes the way it looks, right? So we have to annualize it. And why is that? Because we want to compare it to other opportunities that we may otherwise have. For example, I always say this in videos, and we really need to do a video on it. That the market return average has been about 10% per year. And I dislike that statistic because of other reasons. But if we just use that as a threshold, then we can say, okay, is this annualized rate of return higher than that, for example? And then we take the risk has to be there. You have to be paid for the risk, because now remember that pin I put on the acquisition going through? We're bringing it back.
Yes.
What's the risk? Well, the FTC says, no,
doesn't go through. Yeah.
Right. So I need to be compensated for that risk. What kind of compensation would I want? Perhaps I want a very high annualized rate of return. Right. And I saw that in AJRD. I saw a very high annualized rate of return where at my buy price, where I'm at, I'm expected to make about 21, almost 22% absolute return. And the deal is expected to go through in Q1 2022. Right. So I expect the decision may happen in January or February. And let's say it happens in February. from my time of purchase, which I think was somewhere in October or November. I don't have the date in front of me, but let's take October. Let's say it's the worst of the two. All right. So October, let's say, and it might not be true, but let's make it even worse. Let's say I bought it at the beginning of October. So we have all of October, all of November, all of December, all of January, and then let's say it happens at the very end of February. So that's 5 months, right? So then what we can do is we can say, we take that 5 months, we divide it by 12, and we get 41% of the year, right? So in 41% of the year, you're going to generate, or I would generate, if it goes through, 21%. Okay. So then if I want to find out what is that 21% annualized based on my ratio of the year, I'll take I'm lowering it down because I know it's maybe close to 22% that I might make, but let's make it 21. You see, in every way, I'm handicapping myself, trying to make it as conservative as possible because I want it to be that way. So 21,
okay, yeah. So that's so it's sort of like an implied margin of safety principle here, if that's what I'm understanding. That way, like you can be wrong in the assumptions that you're basically making here, but still, like you could come out okay. All right. Another question that I also have when it comes to annualized returns, what this sounds like it's exceptionally crucial to me, at least, is when it comes to options. Would that be correct in this instance then?
Yeah. So similar, but we'll do that in another video because that's what I was talking with you about earlier. So the annualized rate of return in this case, assuming I bought it in the very beginning of October and the deal goes through at the very end of February, it would be about 50%. So you see, so if the annualized rate of return for the S&P would be 10%, I'm getting compensated with a 5 times the annual rate of return based on the risk. And I don't think, based on my research, that the risk is actually that much. Okay. So that's how I think about it. And that's the thought process that went into this. And that's why it's more or less a very, quote unquote, as I'll say, because I'll admit it, some people will look at the size of the position and say, well, that's very irresponsible. Well, for you, it may be. For me, it's not. A 50% annualized rate of return. The absolute return will be 21, 22, but based on the time interval that it's occurring, the annualized rate of return is in my favor, adequate risk reward, in my opinion, for myself, for my portfolio. Now,
which also makes sense too, sort of drawing further nuance from this. The reason why annualized returns matter is because that takes into account the opportunity costs, and you feel like you're being adequately compensated for the risk that you're taking on with this particular investment. So now, moving on from here, let's actually kind of discuss a little bit of the recent news that has come out to suggest that exactly your thesis might play out the way that you first formulated it would.
So I think I said this in the original video. I'm pretty sure I said this in the original. It's one of our first videos. And I discussed the positions, like some of the thought process behind the position originally. And I mentioned that the Pentagon had sent a letter to the FTC. We didn't know the contents of that letter until today, until the filming of this video. So now we know. I suggested that during that video that the contents would be positive in favor of the merger going through. Today, we got confirmation that it was indeed positive. And now it's the ball's in the court of the FTC. So the FTC is now the final decision maker, and they're going to say whether or not they want the deal to go through. Now we know that Congress petitioned, so senators petitioned the deal to go through. They said, yes, let the deal go through. And then the Pentagon had said, yes, let the deal go through. So now the likelihood, the probabilities that the FTC says no are now much more diminished. It's still very possible though. So it wouldn't make sense, for example, if the stock price rose on this news to $51 a share or just under it, I would have sold. Why? Because, oh my gosh, my annualized rate of return would have been insane. And I take off the risk. I take off the risk that, the deal doesn't go through. So going back, hindsight's 2020, but like, let's say somehow I had a crystal ball, right? And I was just amazing. And I bought it here for whatever reason, just by accident. Could have been just by sheer accident. And the deal gets announced and I skyrocket right here to 26%. I would sell immediately. And I would have some time. I would sell immediately. By the way, I want to just say at this point in time, don't think that the market was just absolutely stupid and charging you $52 for something that would be $51. That's actually not what happened. At the point in time during when this happened, it was a $56 price tag. Okay. Now here's where I'm going to bring back that lesson that I'm trying to instill in everyone for this video. So let's say it's $52.66. You could hold onto it for that extra for $56. And Austin, if you could do me a favor while I'm discussing this, can you calculate the percent return? So just do new minus old over old. So 56 minus 52 point, and I'm going to say the formula so everyone can follow along. So 56 minus 52.66, then divide that number, whatever you get from there, divided by 52.66. What is that?
It's about 6.3%.
So I'm going to be fighting for 6.3% extra, right? And then on top of that, at that time, you knew, or it was fairly certain that the deal would take a long time to go through. Not only that, you would probably be waiting an entire year. Okay. Now you already got somehow, because you're just some lucky guy, you got a 26% return right there. Annualize that out. You know, that's an incredible rate of return. I wouldn't play with that. I would say, all right, I'm out, because fighting over that 6% for the course of a year would not be advantageous. It wouldn't be a good risk reward play, because if you annualize that, it's better to take the money now and then in theory, go invest it in an instrument that gets around 10% per year. So S&P 500, for example, and then you would have actually been better off. That would be the optimal strategy. So you see how the time intervals actually come into play. It's just math at the end of the day. It's math.
Yeah, time's exceptionally crucial for stuff like this. That's basically the
exactly.
story that I'm extrapolating from everything that you're saying.
Nuance. So the nuance of the percent return matters if you tell me the interval of time that it will occur, because that changes the value, the time value of money, right? Remember, you know, like accounting and finance courses that you may have taken.
Yes.
Time value of money. So if I had that, if I was somehow that lucky guy that did that, there are some people out there that did it. There were people buying, right? So someone out there bought shares at that price. The most intelligent decision at that point would be not to wait for the $56 price tag, would be to cash out, take those profits, and then go invest somewhere else, or just hold the cash, because annualize that return. That was incredible. Now we're in this moment. I decided that at the prices I was buying, the annualized rate of return was adequate. We just calculated it. It would be roughly about 50% if the deal goes through. Now, I'm taking on risk that this person over here was so lucky they didn't even take on. So on top of that, the return quality for that investment would have been fantastic. But of course,
it would have been,
that would be just pure luck, or it's insider trading. Okay. So you see, insider trading is awesome. You know, if you but,
that is not an official capital mindset opinion.
No. But like
that's for entertainment purposes.
That's why it's so attractive to these people to do it, because, you know, you know information. But anyway, so here we don't have access to that kind of information. We have access to assumptions, and we take on risks. So the risk that I'm taking on is the deal doesn't go through. And if it does go through, my annualized rate of return will be about 50%. It can decrease. So for example, if the deal goes through in March, still in Q1 2022, let's say it goes on through March, my annualized rate of return actually comes down a little bit. Now, let's say it goes through in January, my annualized rate of return goes up. Now, if I'm being precise,
because of the time value of money. Yeah.
If I'm being precise, if I can eyeball when I got in, I think it was actually here-ish. Yeah, around here. It was actually here. It was around there. So I actually got it at the end of October, right? Not at the beginning of October, because the beginning of October was, actually, no, I might have bought some in the beginning and some in the end. So let's assume it's just the beginning of October for the sake of argument. So I can still claim at least 50% annualized rate of return. So that's pretty much it. So here's the scenario in which I will profit the most. Okay, I think I should cover that. This would be, if this happens, I'll be very happy. You'll see me like being very excited in the upcoming videos when we come back. If the market comes down because of Federal Reserve shenanigans, right, I won't care, right? Because I have a decent amount of cash, right? And this is a cash position for me. I consider it to be a cash position with some added risk and a little extra caveat of gains. If the market comes down and the deal goes through, not only will I be probably wow, that'd be incredible, because my cash would go up in value, right, while the market's coming down, and then I'll have a bunch of cash to then deploy into things I want to invest in. So that's also why it's attractive to me, because it's kind of like in some ways it's a hedge in my portfolio. And for me, again, if everyone saw how much it was, it'd probably be like, wow, that's very responsible. but
Yeah.
but that's why I stress, do not copy me. And then if it doesn't go through, I mean, it won't be the entire end of the world. I actually will probably suffer some paper losses, if we're being honest. And I want to be candid about that. I mean, right now, if the market
Of
comes down a
course.
lot, I can sell right now for about a 4 or 5% profit. And then take those profits and then redeploy into the market. So for example, if I see stuff that's going to give me a higher annualized rate of return based on the risks, of course I'm going to sell before the deal goes through, because I'm seeing greater opportunities. But for now, I'm not seeing that kind of opportunity where I can make 50% annualized rate of return based on these current risks. For me, I think of this as kind of like it's not a layup, it's almost a layup, because I think now, especially after I know what the contents of that Pentagon letter was, I think the probability is fairly high that the deal does go through. So in this case, the best scenario to play out for me would be to have the market, not have the market because I can't control that, but the market comes down because of Federal Reserve policy change or scare or whatever. The deal does go through because the FTC says yes. And so I get to sell at a higher price and then redeploy the capital into depressed assets. I'd be
Nice.
very
Well,
happy.
with that being said, do you have any closing thoughts before I wrap up the show here today?
Yeah, a little quick tidbit announcement. So for those of you who've watched the video where I bought 10 cent at Alibaba, put 10K into each of them, I may have accidentally called the bottom by accident. By complete
Nice.
sheer accident. The video where I announced that I was buying Alibaba the next day was also the day that it seemed for now to have bottomed. And
Yes.
all my criticisms about the structure remain. Remember, the point of me buying it was double-sided. One, I think it's a trade. It is a trade entirely based upon the greater fool theory, entirely based on that, where I do think the VIE structure will be coddled. And, it's not going to be delisted on China's end. The only risk from delisting is the United States end, but I don't even think that's really viable for a lot of them because of how intertwined some things are. And then I do think that coddling, that sentiment change will drive the price higher over the short term. Longer term, the structural problems still remain, but I'm going to profit from that. And at the same time, if I suffer from that, you guys take it that I'm suffering alongside with you, not trying to, make fun of you or anything like that. But that being said, I just wanted to announce that if you guys have noticed that, yeah, that video actually may have accidentally marked the bottom, because again, my theory goes that the VIEs themselves, they're going to rise on price action alone, because sentiment driven, because they are sentiment driven investments vehicles. They are not really, in my opinion, based on the arguments I've made in the several videos that we have about the topic, that they're not actually connected to fundamentals, because there's no core reason for them to be going forward, and it will just be the sentiment of
which we can link some of the other videos that we've done on this topic in the description below. But with that being said, we are your hosts, Austin and Fabio. We hope that you've enjoyed what you've seen here today. If you have any questions for us or would like to continue the conversation moving forward, would like to critique us or agree with us, please leave those comments in the comment section below.
Yeah, I didn't show them the percentage allocation of this. And if I showed that, we would probably, well, I would fully accept it. But also at the stage of the investment life I'm in, but anyway,
yeah,
there would probably be some criticism.
Yeah.
But yeah.
So
Repeat final thought. Do not copy me. Do not follow me on this trade. This video serves as an understanding of a thought process, or a thought process, an example to document it. Okay. And it could be the thought process of a complete mad lad who has zero understanding of how risky something is, right? Could be.
Well, that's humble. All right. Well, with that being said, let's please be sure to like and then subscribe to the channel. Share the video if it helps you out. It really helps out the channel. And then be sure to visit our website at capitalmindset.org. We are your hosts, Austin and Fabio, and we'll see you guys later. Take care.